Picking a strategy that fits your personality. Investing in the stock market can be an intimidating and overwhelming experience for many, especially those who are just starting out. It can be difficult to decide which trading strategy to pursue. Many beginners may feel tempted to choose a strategy because someone tells them it works. And while it is important to get advice and help from experienced traders, it is equally important to make sure the strategy you choose is the right fit for your personality. It is important to remember that nothing works all the time. Even the most successful trading strategies have their ups and downs. It is important to pick a strategy that matches your individual needs and preferences. For example, some people prefer longer-term strategies that involve holding stocks for many months or even years, while others may prefer shorter-term strategies such as day trading. It is also important to choose a time frame that works for you. Different strategies require different amounts of time and effort to be successful. If you are new to trading, it is important to start off with a strategy that does not require a lot of time, as this will help you to become more familiar with the markets before attempting more complex strategies. For example, a strategy that I really like for my personality is when I use 3-minute bars and an anchored VWAP. What I do is I take the first 3-minute bar on the regular trading hours when I'm trading the E-mini S&P, NASDAQ, gold, oil, any futures market. And what I do is I put a horizontal line on the 3-minute opening bars high and the 3-minute opening bars low. So that 3-minute opening range is boxed out for me now. Then what I do is I anchor a VWAP to that opening 3-minute bar. Now, whichever side of that VWAP gets above or below the opening range high or the opening range low, that is the direction that I then like to trade for that particular day. And why that fits my personality is because I like to trade in the morning. I think that the opening hour or two of the market is really my favorite time to trade. So I like to get an early indication of what the market's direction is, and I like to trade in one particular direction. So if that opening range VWAP gets above the high, then I like to trade long. If it gets below the low, then I just like to trade short. If it stays within that opening 3-minute high and low, then I know it's going to be a choppy day and I just stay away from the market. Execution is everything. Execution is everything in trading. And one key aspect of successful execution is understanding when to deploy your trading strategies. Experienced traders know that certain strategies work better in certain market conditions. For example, a momentum strategy may do very well in an uptrending or downtrending market, but it may suffer in a sideways market. Similarly, a long-term trend following strategy may struggle in a choppy range-bound market. It is therefore essential to study the conditions when your strategy works best and when it doesn't. Knowing when to trade aggressively, cautiously, or not at all is crucial to maximizing your profits and minimizing losses. It is also important to fine-tune your strategy to eliminate as many losers as possible. This can involve adjusting the entry and exit points or modifying the strategy itself. This can be a time-consuming process, but the rewards are worth it. Getting the timing right is the difference between success and failure in trading. It is only through rigorous testing and fine-tuning that you can ensure your trading strategy is tailored to the current market conditions and that you're getting the best performance from your trading. For example, if I'm looking to trade aggressively on any given trade, the stars have to line up for me. I like to look at the longer term charts before I go to look at my intraday charts. So if my weekly and daily charts are indicating we are in a bullish market environment and I get a bullish indication on my shorter term strategy, I will trade that very aggressive. Same thing goes if the weekly and the daily charts are showing me a bearish indication and my short-term charts show me a bearish move, potentially intraday. I will also trade that aggressively. Now, if you have a bullish look on the daily and the weekly charts and a bearish look on your short-term charts, That's a time where you want to trade small or not at all because you don't have confirmation on all of your time frames. Be yourself. When trading, it is important to have an established amount of risk per trade, a risk per day, and a risk per month. However, remaining flexible is equally as important. When the markets do not align with your trading strategy or when the signals are not clear, it is important to adjust your risk parameters accordingly. Lowering your risk parameters during these times can help you save your full risk allocation for the days when the markets are working in your favor. Having a set of risk parameters is essential to successful trading. You need to know your numbers in order to make informed and profitable decisions. Without a firm grasp of your risk parameters and your strategy, you should not be trading. By understanding your risk, you can make the most of the ups and downs in the markets. In conclusion, be yourself when trading. Have a set amount of risk per trade, risk per day, and risk per month, but remain flexible and adjust accordingly. Knowing your numbers and understanding your risk parameters are essential to successful trading. For example, I talked about when I would be aggressive in certain market conditions. If the daily, weekly, and intraday charts are all pointing to a bullish move, then I'm going to be aggressive and I'm going to increase my risk per day because the market is showing me a strong look on all my time frames. If the market is showing me a bearish look on all my time frames, I'm also going to increase my risk per day. Now, I'm doing this because there are only certain moments throughout the trading year that the daily, weekly, and your intraday charts are all lined up. So when the stars are aligned, you have to learn to take from the market. Now, when the stars aren't aligned and you have a bullish look on the daily and possibly a bearish look intraday, then they're colliding and you're not going to have clean looks. These are the times that traders most of the time get chopped up because they have a bullish underlying bias from the daily or the weekly, but intraday, they maybe have a bearish look or even a choppy look and they try to force it. During those days, you have to understand and have self-awareness and situational awareness to understand that the conditions are not matching your strategy. So the market is probably going to be taking from you, most likely not giving to you. Learn to take when the market's giving and don't give a lot when the market's taking. Trade according to risk. Risk management is one of the most important aspects of trading, and executing according to your risk parameters is not as simple as it sounds. It is important to note that your entry price should not be a single point, but rather a range of execution based on your risk price. This range of execution will help you minimize the risk of entering your trade at the wrong time while still providing you with the opportunity to capitalize on potential profits. Executing closer to the area where your strategy indicates your trade is wrong, your risk price, will maximize your risk to reward. Risk management is not just about knowing how much you're risking, it also involves taking advantage of opportunities and maximizing profits. This means that you should adjust your strategy and risk parameters as the market evolves. For example, if I have a bullish daily and weekly chart set up, and on my intraday charts, I have a bearish indication for the trading day, what do? What I look to do is when I'm getting short intraday against a bullish daily and weekly bias, I trade as close to my stop as possible. What does that mean? It means that my range of execution is going to be much closer to the stop on a short because the overall trend is bullish. So my initial entry on the short side is most likely to have some slippage closer to my stop. So I will execute closer to my stop when I'm looking to get short intraday against a bullish bias from the daily or the weekly charts. So it allows me to have a tighter stop and potentially I can trade even larger size because my stop is tighter. So now if my point stop is tighter, I can trade bigger with also risking the same amount that I would normally risk with a wider stop. Because remember, if it's a wider stop, my position size, according to my risk per trade, has to be smaller to fit in my criteria. But if I trade closer to a stop, I could trade more contracts essentially risking the same amount as if I was trading a smaller contract size further from my stop. Now, the opposite goes for if I have a bearish trend on the daily or the weekly, and I get a bullish indication intraday. I'm going to buy at or below my entry. I'm going to try and buy as close to my stop as possible for the same reasons I explained why I would look to sell closer to my stop in a bullish daily trend with a bearish indication. Always be a student. As traders, it is important to always be a student. This means that keeping up with the markets and watching them evolve is an essential part of the learning experience. Even if you don't actively trade or backtest, it is still important to observe and take notes. Through this process, you can gain an understanding of how markets move and how to react in different situations. Another great way to learn is to trade mentally. By simply simulating trades in your head, you can observe how you would react to the markets and take note of your psychological tendencies. This practice can be invaluable when you are ready to live trade. Finally, learning from other people's mistakes can be an incredibly helpful tool. If you are able to find experts in the field with a proven track record, you can learn from their successes and their failures. This can help you to avoid making the same mistakes that they have made in the past and can improve your overall trading. In conclusion, as traders, it is important to always be a student by actively watching the markets evolve, trading mentally, and observing other traders with proven track records. You can learn invaluable lessons that can help you become a successful trader. For example, there's a lot of times I will wake up in the mornings looking and seeing what the market action is showing me for that current day, and I just don't really have a strong indication of what the day may bring. So what do? I sit back and watch and learn. Just because I'm not trading doesn't mean that I'm not learning. And just because you are a day trader, that doesn't mean that you have to trade every single day. I've learned so many things about markets just by watching. I have figured out ways to make money on days where really the market did nothing, but I learned something from watching the price action. It's always about understanding the current market environment. And a lot of times you can really get in rhythm just by watching what the market's doing. So the next time you step up to make a trade, you can recognize what happened on a previously similar type trading day, and then use that ammo to help you become a better executor of your strategy in those same types of conditions. React with reason. When it comes to trading, it's important to practice a certain level of restraint. Just because the market is slow or busy, that doesn't mean you need to make a trade. The key is to only trade when your strategy gives you a reason to trade. It's so easy to get caught up in the moment or to get bored, but it's important to remember that taking on unnecessary risk is a surefire way to deplete your trading capital. Take a step back and analyze each trade you take on carefully. Make sure it fits into your trading strategy and that there is a clear, rational reason for you to take the trade. This will help you to make more informed decisions and make sure that you are trading with reason. For example, some of you may be familiar with what was called the flash crash. During that day, I had just moved into my office down here in Florida, and I remember sitting down at my desk and seeing the market just start to fall out of bed. I stepped in when I saw no news going on at all, and I started to buy the market. Next thing you know, I was down a lot of money. And before you know it, I was getting stopped out of these positions way worse than what I intended on risking. And then ultimately, I saw the market go limit down. And I had realized quickly in those moments that when I saw where we were across the board, that this was a time I could potentially step in with reason and manage my risk. Thankfully, I was able to make back all the losses that I had taken on at a time where I didn't have a reason to trade and ultimately turn the corner. But now if I had just waited to react with reason during that time, I would have had a far better day. And I was also susceptible to potentially even blowing out an account because the market was moving so aggressively to the downside and I was going against it without any reason. So remember, there will always be times when there's reasons for you to trade, and those times are where you're going to make your money. Learn to be aggressive. As a trader, it's essential to learn how to be aggressive when trading. When you're making money and your strategy is paying you, it's important to keep trading and even consider increasing your risk per trade. This approach can help you reach the next level of success in trading. Of course, taking on additional risk carries with it the potential for greater losses. That's why it's important to understand the concept of risk management and to have a good understanding of your own risk profile before deciding to increase risk. When you've identified potential opportunities for higher returns, you can use strategies such as scaling in to increase your risk in a controlled manner. Overall, if you're able to identify and take advantage of opportunities as they arise, you could take your trading to the next level by being aggressive when the time is right. Using the right strategies and techniques can help you maximize your profits while still protecting your capital. For example, at the beginning of my career, I would go back and look at all of my trades and I would realize 15 out of 20 days a month, I would be making money. And I'd have a couple days where I broke even and a few days where I would lose money. And ultimately, when I looked at my P&L throughout the month, I barely made any money. And I thought about it and I said, I'm making money 15 out of 20 days. That's pretty good. Why am I still really not making money? And I realized that when I looked at my winning streaks, I was just making the same amount of money every day. And if it was really early in the morning, right away at the beginning of the day, I would just stop trading. And then ultimately, the days that I had bad days and bad trading, I would keep trading all day and I would rack up a bunch of fees and commissions on top of my losses. So that would really dig into my profits. So I was fighting it on the days where the market wasn't giving me anything. And the days it was giving me everything I wanted, I was just taking my money and walking away. And I learned that in order to get over the hump of just paying the bills or breaking even in this business, you've got to push through on the days that the market's giving you exactly what you want. You have to take as much as the market's going to give you. And the days that the market's just giving you nothing and it's a struggle, you've got to give the market very little. It takes a special discipline that you learn over time. But once you learn how to be aggressive when the market is showing you exactly what you want, that will help you take you to the next level in your trading. Get out of losers. It's easy to understand that getting out of a loser is an essential rule of successful investing and trading. But for some, it may be the most difficult rule to apply. Losses can be difficult to accept, and it can be tempting to stay in a situation that isn't working in the hopes that it will turn around. The key is to remember that getting out of a loser when your strategy tells you to is in a sense a victory in itself. Analyze the situation objectively and make sure to adhere to the rules of your strategy, even if this means taking a loss. It is important to recognize that while losses can be unpleasant, they are often a necessary part of the process of achieving success in the long run. By getting out of a loser, you will avoid further losses and have the opportunity to put your resources toward more successful trades and investments. It takes discipline, but the long-term benefits of following the rules of getting out of a loser is worth it. One thing that happens to all of us in trading is we develop bad habits. The worst habit I ever developed was when early in my career, I would have a losing trade on, I didn't want to get out, and that trade would then eventually turn into a winner, and I would say, you see, I knew to keep this trade. We've all been there, we've all done it, but what I didn't realize is I was actually stealing from my future. Because once you start to develop that type of bad habit, that bad habit is very hard to kick, and eventually down the road, at least for me, in those moments where it didn't come back, it burned me, and I ended up even blowing some of my trading accounts. So remember, getting out of your losers is developing a good habit. Know when to stop. Making wise decisions when trading the market is an essential part of being a successful trader. One of the most important decisions you as a trader makes is to know when to stop and walk away. This is especially true when you're feeling unwell, frustrated, or something else is going on in your mind. Even if the current market conditions look favorable to you and your strategy, you need to know when to take a step back and walk away. Trading while feeling sick, frustrated, or distracted can lead to you making decisions you would not otherwise make. It can be hard to make the decision to stop trading, but it is essential to regain focus and study the market until you are in an optimal state of mind for trading. This will help you make better decisions and help you to avoid costly mistakes. Making the decision to walk away when you know you should takes guts. It's important to remember that the markets will still be there when you return, and you will be better positioned to make wise decisions when you have regained focus. So if you find yourself in a situation where you need to take a break, don't hesitate to do it. Just do it. Your trading success depends on it. I remember a time in my career where my dog was not feeling well. She was towards the end of her life, and she had just been my best friend for many, many years. And knowing that she was not doing well really impacted my mind. I was coming in every single day in really a depressed state of mind. And it didn't matter what the market showed me, I just could not seem to execute. But I thought by going and trading, it could be a distraction from what was going on in my life. And throughout that time, I just kept losing money, and it actually made the pain even worse because now I'm thinking about my trading and my dog, and it just made things so difficult for me to come in and actually go into the arena of trading and compete. So remember something, the market's always going to be there. So you don't need to do something when you're not feeling in an optimal state of mind to execute. Respect the way you are feeling and know when to stop. Be disciplined. Every trader knows the importance of being disciplined in their trading, but very few really understand what it means. Being disciplined is not just about following your strategy, but also your process. It involves preparation, the anticipation of trade setups, and execution. These are the building blocks of disciplined trading, and it must be taken very seriously. It is also important to note that your personal life and trading life are connected. If you are not disciplined in your personal life, then you cannot expect to be disciplined in your trading. Therefore, it is important to create a disciplined lifestyle to ensure that your trading goals are achieved. Discipline is the cornerstone of successful trading and should not be taken lightly. If you are willing to put in the hard work and make the necessary sacrifices, you will be well on your way to becoming a successful trader. Everybody talks about being disciplined, but not everybody understands what it means to truly be a disciplined trader. It doesn't mean just be disciplined to your strategy. That's one aspect of it. It's about being disciplined to your routine and what you're doing before you begin to trade. It's what you do during the trading day. It's what you do after the trading day. It's what you eat. It's your exercise routine. It's all these things combined because your personal life is connected to your trading life. Whether you want to believe that or not, you could have the best strategy known to man. But if you are not mentally in a great place, physically in a great place, no strategy will end up working out for you. You need to have the mental, physical, and of course, the strategic side of trading all working for you in order to have success in trading. Work-life balance to increase trading performance. Having a good work-life balance is essential for anyone in a performance-based profession, such as trading. It is important to recognize that your mental and physical health play a significant role in your ability to succeed in this field. Stress and exhaustion can lead to bad decision-making and an inability to focus on the task at hand. In order to maintain a healthy balance between work and life, it is important to take breaks, get enough sleep, and exercise regularly. Set aside time for relaxation and leisure activities can help to reduce stress and keep your mind and body functioning at their best. Additionally, it is important to practice self-control and develop situational awareness to better prepare for trading decisions. Successful traders understand that their performance is the result of a combination of hard work, dedication, and the ability to maintain a healthy balance between work and life. Taking the time to focus on your personal, physical, and mental health can have a significant impact on your ability to perform at your best. Investing in yourself and developing the skills to manage stress and optimize your work-life balance will make you a better trader and lead to greater success in the long run. As you can see in all these videos, I love Michael Jordan, right? I'm a Chicago boy, grew up watching the Bulls. I thought that Michael Jordan was the best athlete of all time. I wear his gear, I buy memorabilia, and I do that because he stood for something bigger than basketball. He stood for success, winning. Winning is very difficult. And Michael Jordan was the best basketball player prior to meeting Phil Jackson. But did he win championships? No. What Phil Jackson taught Michael Jordan was the ability to control the situations, situational awareness, slow things down around you. Most people that know about Phil Jackson, he talked a lot about living a Zen type life. He did the same thing for Kobe Bryant, Shaquille O'Neal. There's a reason why Phil Jackson was such a great leader for Michael Jordan, Kobe Bryant, Shaquille O'Neal, is because they had the physical capabilities to be great, but they didn't quite have the mental side down. And that goes for trading as well. You can have a great strategy. I have found some very high probability strategies that I felt that for sure with these strategies, I don't need to worry about anything else. I'm just going to go in there and make money because this strategy has such a high probability. But why wasn't I winning? I wasn't winning because I didn't really know how to be a winner. I didn't understand that it took more than just having a winning type strategy to become a successful trader. It takes the whole package. So work on your mind, work on your body, work on your strategy. And when you could put all of those together, you are the complete package and on the path to successful trading.